Welcome to another webinar with IREI Live. This is part of our broader series we've been doing for about a year and a half. Today's webinar is Why Multifamily Now? A selective look at multifamily markets and strategies in the United States and Europe. First, before we get started, we want to thank our sponsors for making this event possible. We have Heimstaden, Heitman, Juniper Square, and Lionstone Investments. So this is going to be broken into two sessions. Session one will focus on universal strengths of multifamily investments in the United States and Europe. And session two will cover defining opportunity sets in selective markets in the United States and Europe. We're delighted to have Nick Russell, who's head of investor account management at Juniper Square, as our moderator. And he's going to be running today's program. So bring in Nick here and let him take it and introduce our first panelist, and we'll get this started. So thank you, everybody, and enjoy the webinar.
And thank you, Jason, IREI, for hosting today's conversation. Before we get started, I'd like to ask our expert group of panelists to kindly introduce themselves to our audience. Maria, let's start with you, then Stanislav, then Caleb, and finally Hans.
Thank you, Nick, and welcome everyone. My name is Maria Surina. I'm a senior director covering real estate with Cambridge Associates, primarily focused on the US real estate universe, but spent a bit of time on the European real estate strategies as well, and happy to join the panel today.
Hello, I'm Stan Kubacek from Heimstaden. We are a European integrated owner, operator, investor in rental residential across 2 European countries. Currently, we own and operate more than 150,000 apartments, and I lead the acquisition team.
Hi, my name's Caleb Mercer. I work for Heitman, a global real estate investment manager. I run our European acquisitions and asset management. We invest a huge amount in the residential sector in Europe, across multiple Western European geographies.
Hello, my name is Hans Nordby. I lead research and analytics for Limestone, which is a member of the Columbia Threadneedle family that includes Threadneedle in Europe and BMO Rep in Europe as well. We develop mixed use environments that includes office, residential, retail, and quite a bit of multifamily here in the States.
Thank you all, and thank you, Hans, for preparing slides to set the tone for today's discussion. I'll now hand it back over to you to take us through them.
Well, very good. So we'll get that started and share that slide. So I think a lot of the panelists will have similar comments on a lot of the thoughts that we're going to present in our slides. Very much look forward to hearing all of them. And I think these are things that are relevant to all multifamily investors today. My slides will focus here on the US, and we can go into some of the concepts that would apply elsewhere. What I'd like to start with is a slide that covers concepts that really matter to investors on two levels, income growth and inflation hedging. So what we see here is there's a very strong relationship between income growth and rent growth in the multifamily space. And this correlation is so good, it looks like we're making something up, but actually it stands to reason. Households that make more money generally pay more in rent. And what we've seen over time is that household incomes are very correlated with inflation. So multifamily and single family rentals, we're finding, are some of the best inflation hedges available, and also offer some of the best income growth opportunities, especially in an environment where there's so much more working at home, that's transferring some of the demand from office or other spaces. Now, this doesn't work everywhere. We also have to look at demand growth and how that takes place at the regional level, the city level, and how that relates to the amount of supply that you have underway. We see here in the upper right is working age population growth here in the US. And that is as low as it's ever been. It's the lowest that's been since the Spanish influenza of the early 1900s, which is a long time ago and before we have any good multifamily data for. But I think it would show us pretty clearly that if you're going for demand growth, looking forward, you need to be looking pretty carefully in the States, just as people have needed to be careful in Japan, Germany, and other Western countries with slower demographics than they've had in the past. But this isn't true in every city, just as it's not true everywhere else in the world. A geography that we focus on called the hockey stick markets, which I'll show you graphically in a minute, is actually much stronger demographic growth. And I think other panelists look at this in a different way in terms of slicing and dicing their cities, and they'll have similar comments. What we see here is that working age population growth is about 1.2%. And if we look at the 30 to 44-year-old age group, is actually very strong. According to Moody's, is mid 2% range, which is third world demographic growth, in this case priced in American dollars and with American laws, which is a fairly rare combination. The reason why I highlighted this 30 to 44-year-old age group is because that's where the growth is. That's important for multifamily on a couple levels. One, over the course of the 2020s, this demographic group will average 36 years of age. The millennials, which is the largest demographic group here in the States and in most of the Western economies in terms of working growth and where the growth can be had. These people don't want the same things they wanted in the last economic cycle when they averaged 26 years of age. As an economist, that's the easiest call I can make, right? That they will average 36 and in the past average 26. So what does that mean? Well, when you're in their mid-20s, you want to live and work downtown in a studio that's walking distance to the office and is convenient to meeting people you want to date and going to the gym. When you're 36 years old, your wants and needs quite often change. You might have a household or a child, things of this nature. So transfers where the strength of demographic demand is to a place that's different than the last decade. When we look at the geographies I mentioned, the hockey stick markets, and other people will look at this differently, and very much look forward to hearing everybody's comments on the panel. We made it very simple here. If we look at three factors for the 2020s that you think will matter for economic success of the metropolitan areas, if we look at the types of industries that drive the local economy, look at the exposure of a metropolitan area to onshoring, bringing manufacturing back to the US, friendshoring, things of that nature, as global economic trade divisions start to crop up. And we look at migration, where there's net migration and population growth on a metro by metro basis. Based on those three ways of looking at the world and weighing the markets, making it real simple, red, green, and yellow, we would say that these are the markets in green that are best positioned to take advantage of growth in the 2020s. The yellow markets, somewhere in between, and red markets will be pretty challenged over the course of the next couple of years. This doesn't take into account supply, which is very important for multifamily. I thought it'd be a fun way for us to kick off the conversation, and to the extent other panelists disagree, which is great, gives us something that we could lever off against. At this point, I'd hand it back to the panel.
Thank you, Hans. With the Colorado Avalanche winning the Stanley Cup, I'm glad to see Denver considered to be a hockey stick market. Would love to gauge the reaction of the other panelists to Hans's slides. Does anyone want to offer up their feedback?
Hi, I'd say from a European perspective, it's really interesting to see the analysis Hans is doing. It's a similar thing we see in Europe, where some of the markets are growing very strongly, like the Nordics and the UK. And so they're very positive demographics combined with big supply constraints. You see that coming through in the rental growth and over the long term, the price growth over the long term. So it's interesting to see in the US, which is a much freer market, you're already undertaking that same analysis in the same way. And some of those same things are coming through. So.
Thanks, Caleb. I do see that a question has already come through in the Q&A in terms of, is this session being recorded? Yes, it is being recorded. Yes, a link to today's session will be shared with all of the attendees. Also, about halfway through each session, I'll monitor the Q&A and share some of your questions with the panelists. So please continue to share those questions with us. Now, diving into the questions a bit further, multifamily is often used interchangeably with residential or apartments. So think of your traditional high rise, your garden style, or even student housing. Stanislav, what are the main differences between these subsectors that underpin multifamily generally? And do you find the differences between them to be obvious or intentional?
It's worth mentioning that Heimstaden is very much a European owner-operator at this stage with 20-year history, Nordics, in Central and Western Europe now. And what we mainly manage and own is kind of mass market multifamily, older stock, new stock that we have developed for us with sort of some level of amenities. We have some stock which is more for older people, younger people, but we stay close to sort of the mass market. And I like your question, Nick, about kind of defining what is multifamily and what are the differences in the kind of sub products, especially in today's kind of in 2022 with all the turbulences we have in potentially operations, but especially the financial world and valuations and financing, because I think it can be it's a different proposition in a down market, and when people are worried about valuations and financing, if you are maybe having kind of high amenities, high operating costs, a co-living scheme with a lot of common area what you try to kind of make a commercial use of, and small units which sort of small residential units, or if you have your more mass market traditional multifamily with 30 to 50 square meter self-sufficient apartments where a couple and family can live, which can be even from a planning perspective, for example, condominiums, and sold individually in a downturn. And we have always stuck closer to over the last 20 years to owning sort of residential as any owner occupier would own it, and build it to the same quality, or have it built by our development partners to the same quality, not compromise on quality, so that we have our stock valued as almost like a sum of condominiums. So I think in today's market, it's important to differentiate between the mass market multifamily and sort of the derivatives of variations. You mentioned student housing, co-living, or highly amenitized schemes, or highly dense schemes with really small micro apartments, and which may give a higher yield and a higher per square meter value in an up market when everything is rosy, but which tend to be less defensive in the world as we're living today and for the next couple of months.
Thank you, Stan. Speaking of subsectors entering the mainstream, single-family rental market seems to be cooling a bit, at least here in the US. Maria, do you think this will have much of an impact on the multifamily sector generally, or do you think it's still too small of an asset class?
It's a good question, Nick. I think single-family rental has certainly been the focus for many institutional investors lately for similar, I think, resilience that multifamily brings, and kind of going back to the early comments about millennials reaching the age of 36, right? And that's when families and school districts become more important. So certainly the, I guess, market correction that is taking place right now is impacting both multifamily and SFR space. But I still think both would have strong demographic tailwinds to stay relatively resilient throughout this time.
Thanks, Maria. Switching back to a bit more high-level view of the sector as a whole, Caleb, why do you believe multifamily has performed so well historically?
Thanks, Nick. It's proven itself through multiple periods of volatility. It's really proven its resilience in times of difficulty. That the income streams are very needs-based, and in Europe in particular, a lot of the tenants are supported by governments in times of difficulty, so they have the capacity to keep paying the rents. And as a result, what you've seen is consistently high occupancies and consistently high rental collections. If you look at what happened during coronavirus in the listed REIT space, the residential sector had 95 to 100% rent collection, whereas it was a very different outlook if you go into offices, retail, obviously even logistics had much wider range of outcomes given the exposure to retail tenants in that sector. So It's really proven itself historically as being a very robust, reliable sector in Europe, where the tenants just, the supply constraints are so big, they just don't have anywhere else to go, so they need to keep paying the rent. I think to the question of to how it's going to perform now in this crisis, it's interesting. It's obviously a different crisis because you do have the economic side, but you've also got inflation coming through. And one of the things that makes Europe so robust is we have a lot of regulation. It's not true in all markets. Markets like the UK are very liberal, but you go to markets like the Nordics or into Germany, where we operate and own and operate a lot of stock, or the Netherlands, where we also own and operate a lot of stock. And there's an awful lot of regulation there. And it's a very politically sensitive area. And will they let us push rental increases through at 10% per annum and numbers like that to a core voter base for a lot of the politicians? It's probably not realistic to expect that to happen. So it will keep, the rents will keep coming in, but will we be able to keep growing them in line with inflation? I don't know. So I think that's the big question for the current environment. And you're seeing that being reflected in the valuations of some of the listed companies in the stock market right now, and I'm sure we'll get onto that in more detail.
Thanks, Caleb. Since we all know past performance is not indicative of future results, Maria, do you believe the role and/or attractiveness of multifamily has changed given the current inflationary environment and rising interest rates?
That's a good question. Obviously, multifamily has shown resilience throughout cycles. And again, not only because it's a truly demographic-driven essential sector, but also because of attractive financing available to the sector through agencies. Speaking of inflation, of course, whenever you can evaluate the sector in terms of its inflation hedging or sensitivity, you have to think about the supply-demand balance and the ability of a landlord to pass on those increasing operating expenses. With regards to multifamily, we know that overall vacancy increased to 3.1% or something like that, which is still relatively low compared to the historical averages of 5%. We know that rent growth is strong in multifamily. Again, we discussed that it has slowed down to 14%, but it's still 14% and not 3% that maybe I used to underwrite early in my career. So it's still a lot of fundamentals are there. At the same time, we do have concerns about construction and the amount of maybe potential oversupply in certain markets. So definitely headwinds in some markets, but at a high level, I would say that there's still pretty strong landlord power to pass on those expenses. And obviously, the attractive feature of the multi is that the leases are relatively short. We're talking about 12 months on average for the lease term. So from those perspectives, I would say, yes, multifamily should offer good inflation sensitivity. In terms of rising interest rates, I think I will take it from the angle of affordability and home ownership affordability specifically, because we do know that 30-year fixed rate mortgage is now easily north of 5%, and that was more like 3% early this year. So while we do talk a lot about maybe softening in the home sales, which may certainly be helping the new home buyers, still you kind of question whether that offset and price decline will be enough to take on the higher mortgage and afford that home. So I guess where I'm going with that is rising interest rates certainly make homeownership challenging to a degree, and that should support, I think, demand for the rental, which is multifamily, sort of targeting demographics. Right. So those are my remarks to your question.
Thanks, Maria. And we're not quite at the halfway mark, but we've already gotten quite a few questions from the audience. So first and foremost, thank you for that. But perhaps I will start weaving them in just as they are relevant to the current discussion. Specifically, questions around pricing and pricing related to fundamentals. So one specific question is, one item that we continue to hear is property level fundamentals are still very strong in multifamily, but it is not matching up to that of capital market statistics. What is the disconnect there? Can one of the panelists tackle that question for the audience?
I can do it from a European perspective. I mean, the big listed European companies that tend to be German focused. If you look at Germany, the fundamentals are very positive. You're seeing full occupancy, some rent growth coming through, but there are probably a few factors weighing in. One is that issue whether you can keep growing your rents in line with inflation, which is probably not going to happen. The second issue is a squeeze on your free cash flow driven by increased operating costs, but also increased capex requirements. So inflation's increasing the size of those capex requirements. There's ESG requirements that will come through as well that we'll talk about more later. So as a result, your free cash flow is getting squeezed because the rents were pretty low. So there isn't much room to absorb too much growth in capital costs. So your free cash flows are getting squeezed. And then lastly, it's the swap rates, the increase in swap rates. With the yields being so very low, a lot of the capital value was in the residual. And so as a result, they're very sensitive to rises in discount rates, and the gap between your in-place yield and your cost of debt is very important. And so as the swap rates have risen, it's a bit like a long duration bond, the values have fallen off. So combination of the squeeze on free cash flow and then the rise in the cost of swap rates has really put pressure on those German companies. But it's true even in the free markets like the UK, those same factors are playing in, and not to the same extent. In Germany, it's a 30% discount to GAV. In the UK, it's more like a 9% discount to GAV. So we're seeing that come through, and it's true in the private markets as well. By the way, what you're seeing in the listed markets, you're seeing in the private markets, residential values are off by varying amounts. So that, yeah, I think that would be my explanation as to, despite the good fundamentals, why you're seeing that sell off.
Perfect, thanks, Caleb. Stan, do you want to tackle that one as well?
Yeah, maybe I can add a few points from our perspective as being a large owner of German multifamily, owned about 30,000 apartments in Berlin and in other places in Germany. And maybe for the American audience, just to add on the disconnect between the private market and the public markets, which are trading at the heavy discount today, is the fear of the operating costs, as Caleb said, and on top just kind of basic operating cost inflation is the energy supply. There's a lot of question marks. What will be the cost of anything with related to energy and the gas supplies coming from the east, from Russia for the next 6, 12, 24 months before it can be kind of sorted out and rerouted from other sources, and sort of that kind of uncertainty if the inflation or in operating costs coming through the energy supply is 10% or 100 or 200%, and then how will households react and what will then happen to ability to push rents to cover up this is, I think, a short, probably medium term weighing on this as well. Plus, there is kind of the usual, I think, capital markets dynamics of liquidity in the market, which is relatively low these days in Germany and everywhere in the public space. In the private space, transactions are not happening. They are stuck due to bid-ask spreads, and the volumes traded on the stock exchange of these multifamily rates were relatively low as well. Plus, not really knowing which scenarios are the right ones for the future in terms of the OPEX, the rental growth, interest rates, and valuations. And we had the same at the beginning of COVID. For the first couple of weeks, it was a really downgrade of the listed multifamily REITs in Europe and in Germany, and then we saw rents coming through, occupancy being very, very strong, valuations as well, transactions keep going on, etc. And then that has re-rated. Now it's been on for a few months, not just a few weeks, but because the threats are different. In COVID, people were staying home and paying rents. Now we don't know what the operating cost through the energy supply chain will be for the foreseeable future.
Thanks, Dan. Maria, anything to add on the U.S. market specifically?
Maybe just a couple of comments here. I hear the sentiment that why is public market down 20% REITs specifically, and then the private, I'm going to pick up on Odyssey, the core real estate post a 4% appreciation in the same sort of time frame, and I think it's a very legit question. But we know that public markets just tend to react much faster and sometimes overreact. Private markets are lagging, take more time, and I'll give you a big secret. I'm a former appraiser myself early in my career, so you do base your sort of market conclusion based on the sales activity, right? And we certainly acknowledge that while Q2 wasn't busy quarter. It may not have been as busy as we expected going into 2022. So there's definitely a slowdown of market activity. And for that reason, maybe lack of evidence to conclude a meaningful evaluation adjustment, at least in the private market. I think Q3 is something to watch. We probably won't see any material write-ups in any sector at this point. But I appreciate the sentiment that there's a bit of a disconnect right now. At the same time, it can present an opportunity for those willing to make a tactical bet on where the public markets stand today, and sort of maybe invest when there's meaningful discounts to the NAV for a lot of those multifamily REITs.
Thank you, Maria. Hans, now that you've had a breather following your presentation, what are the key cultural, social, and regulatory similarities and differences between the US and European markets?
Well, that's a big question. I'm sure a lot of people on the panel have a comment on that one, but I would hit at a high level what the similarities are. And I think there's really three areas where we see some similarities. Housing shortage. So there's so many Western markets that first were hit by a decrease in the amount of capital and decrease in construction for housing after the end of the last cycle, which was about a housing crash. And following that, we've got a sort of sclerotic regulatory regime set, European and American, that's retarding housing supply, just at a time when people want more of it. And then we have the millennials, which, although more of a driver here in the States, where there are more of them than in some other countries, in general, this is the shape of demography in the West. And the millennials, as I mentioned earlier, are a different stage of their life. And that's not just in terms of being grown up, potentially having a family, it's also the marginal propensity to consume space. When one's 26 years old, you might consume 500 square feet of leased space, and that could be in a shared flat. When you're 36, you're making more money. You're planning for a different future, and you may want to locate to an area that's not part of a 50-story high-rise downtown. That's a little bit more common in the States than in Europe. But in general, it's a different consumption profile and location. It's more square feet in a slightly different area. So that's something that's a little bit more pronounced here, but a worldwide phenomenon that we're seeing, and migration. And this is profound. Over the last 2 years, we've seen the pandemic pop in demand for residential space. Why? You're working at home more, and more people pulled forward those decisions that come later in life to purchase a home or rent a home, et cetera, which increased the amount of demand quite a bit for residential space. And that pop benefited all markets. Akron, Ohio, where demographically there is very little going on, and I hope I'm not offending anybody from Akron right now, but we all know this, versus other markets like a Raleigh, where there's plenty of in-migration. This is also true we see in Europe, and it's been true globally. So in Japan, Tokyo's held up much better the past 20 years than provincial cities in Japan that have been the demographic oxen which have been gored by a declining working age population and overall population. So again, housing shortage, millennial pop, and migration. And that's all been backed up by a change in technology. So those are the things that make these regions similar. And in terms of the differences, well, that list is fairly long. As Stan mentioned earlier, the regulatory regimes are much different in Europe than they are in the States. And they're much different between regions here in the States. Cities like St. Paul, Minnesota, have enacted rent controls over the course of the last couple of years. And regulatory regimes are much different in different states and cities. Which is one of the reasons why some cities in the States have 10% of the inventory of apartments underway today. Staggering numbers. So going forward, how this plays out is a big difference between different sides of the Atlantic. So it's probably too much of me talking. I'll turn it back to the panel.
Thank you, Hans. Stan, do you want to expand on some of the ideas that Hans suggested for the European market, specifically those that are creating tailwinds for the sector?
Yeah, I'll try to answer in a way that could be also interesting for the audience. and not just us, that kind of panelists exchanging our views, is we shouldn't forget that the European market is much more fragmented. It's a lot of nation states, language barrier, there's some cultural differences, and the job markets are not fluid. People don't so easily move from southern Spain to northern Germany for a job, etc. So it's much more fragmented. There's various kind of local specificities starting from regulation, but then kind of the tenant and landlord kind of relationships and tenant expectations. And so I think what I'm thinking could be interesting for you is to mention is that I feel that it's maybe more important to have a good operator in Europe who understands the local specificities, the tenant expectations, the cultures, the migration flows, job markets, and all the kind of fundamentals. So supply, demand, job migration, where is the wage growth and the employment growth, etc. But also the local regulations. And if you are in the US, I would think, despite St. Paul, Minnesota introducing a rent control, that the markets tend to be more liberal, tenants kind of more fluidly moving around, and so the market is much bigger and probably kind of less fragmented, more uniform. And please, people, correct me if I'm wrong. And which probably tends to emerge kind of strong institutional operators of resi who can operate with you in Dallas, in New York, in Raleigh, in St. Paul, Minnesota, and can do a very good job to a resi investor. Whereas in Europe, to find a good operator across Spain, Germany, and Sweden, I think it starts to be challenged. The markets are different, the liquidity is different, regulation and language and operators tend to be relatively kind of country specific. Apart from I think it's changing and it's getting there, and we've grown from the Nordics into 10 European countries in the last 5 years, but it's the matter of the last 5 years, not the last 20 years.
Thankfully, we're not in person, or Jeff Dorman or Chase would probably gong me for this one. But another question from the audience, and Stan, I'll direct this to you as it's the perfect segue from your last comment. Are there any European multifamily developers or operators that are emerging as market leaders or gaining critical mass?
I don't know what's sort of the ethics in this panel of kind of talking about specific names, but and I talk about ourselves in 10 seconds just because I know our business best. We are today in 10 countries. We own more and operate more than 150,000 apartments. It's more than 30 billion euro of value, everything in the mass market resi space. And I think that actually makes us quite unique to be in so many countries with such kind of critical mass in each of the countries and operate it on our own. There are a number of other operators and managers. I'll quote a few without any particular ranking or just kind of to give out a few names for people who are not so familiar with the European market. Patrizia, Catella, Roundhill, etc., who tend to lend themselves to then their operations and asset management to resi investors from around the globe, and who cover a number of markets as well. And then there are very good local operators in Italy, in Germany, in Sweden, but who tend to do mainly one or two markets.
Thank you, Stan. And another question this time for you, Hans. One of our attendees is curious as to why no Florida markets are in your hockey stick map. Apparently, we have some Tampa Bay Lightning fans that like to remind us that they were in the Stanley Cup playoffs as well. So if you could please address that and why that was omitted from your hockey reference.
Well, historically, first of all, I'd say that there are definitely some markets that we would factor into that hockey stick reference. This just happens to be an in-house map. We're not very active in Florida right now. I would say Florida, wow, the in-migration story is amazing. In terms of the high value add employment area, we focus on certain employment codes, et cetera, and about 20 million of the 151 million US jobs that have the highest GDP per employee and have the highest growth number of employees, so more growth, more GDP output. And those jobs are growing in Florida, not growing as quickly as they are in Austin or Raleigh or some other markets. So it's a different type of play. It's not entirely mid-market, but it tends to be more mid-market than we generally focus on in terms of our work. A lot of opportunity, could be a great market for us in the future, strictly an oversight because we're not as focused on that market. So mea culpa.
Thank you, Hans. I appreciate that. Understanding that asset allocation is only half of the performance equation. Curious to hear the panelists' thoughts on the selection component. Maria, starting with you, how can managers differentiate themselves in the multifamily space?
Nick, I received this question from a lot of meetings I'm taking. Are we differentiated from other multifamily managers? It's a very actually a difficult question, and I would say the answer is depending on what kind of strategy a manager pursues within multifamily space, the answer will vary. First of all, obviously multifamily is overcrowded, and there's a lot of institutional and private capital in the space, and it's a pretty, I think, straightforward sector, maybe traditional in a way compared to maybe some other niche alternative sectors that have evolved in the last decade. So a lot of players. So how do you say differentiated? I think if you're a developer, your edge can be in your ability to source materials directly or buy cheaper or have in-house construction teams, so you don't need to chase teams to build the homes. If you're in a value add space, which a lot of multifamily players would fall in that category, I think that knowing your market and being able to source off market to the extent it's possible is certainly a way to generate some alpha. The list can go on. If you do renovations, maybe get smarter about how you do renovations. Maybe you don't need to wait for tenants to vacate the unit before you start changing. Maybe certain things can be addressed while tenants live there, and it's a win-win because you can improve the quality of the asset, you can improve the quality of the tenant experience in your unit, and you can increase your rents much faster and have less of the downtime. So I think all those things need to be counted. Or maybe the last one, if you're in affordable housing, I guess the edge comes in your ability, and I'm talking about truly affordable housing, like regulatory components. I think you need to understand this political regime you operate in and have that very good in-depth understanding of the regulations within that sector. I think you have to really care about the tenants, and not that you don't have to care in other sections, but thinking through the social impact and how it all comes together. I think in affordable housing, it becomes very important, and this is something we're really focused on when we talk to affordable housing managers. So a lot of criteria. I don't think there's a secret sauce, but I think sort of being aware of your space and trying to stay as differentiated as possible. Otherwise, you just become beta, and who wants beta?
Thanks, Maria. Appreciate that. Curious to hear from the managers on the panel whether you have any reactions to that or other ideas that you may want to share with the audience in terms of how you differentiate yourselves.
I think it's different in Europe and the US. I can see in the US, those are the key things. I think in Europe, I mean, Stan touched on it, there's this lack of institutionalization of the market, the lack of good quality pan-European operators, and the markets are very fragmented and local. So in Europe, you can do really well playing into that. A lot of the investors like Stan are moving out of their domestic markets and going into these other markets. And similarly, we started off in the core markets and are now in 7 countries. And part of the reason for that is the opportunity shifting. If you want to create the value returns, you've got to go into some of the newer markets that the big institutional investors are trying to get into. And what you find there is there's richness of opportunity. It tends to be physical opportunity in the real estate operational opportunity and just sort of portfolio creation opportunity, because you'll go in, you'll find these unsophisticated owners that perhaps haven't had the capital available to invest into the properties, or there's been no incentive for them because the individuals managing it haven't been incentivized to really make value in the property. So you can go and put capex in to improve the properties and play within the European regulations that let you do that. Operationally wise, you can improve the leakage. Stan was talking earlier about the importance of energy costs at the moment. So one of the things you can do in some of the markets where the landlords bear that is you put in AI temperature controls on the radiators, and you really narrow that operating leakage. So you can do operational improvements. And lastly, you can just buy lots of individual properties and create these institutional scale portfolios. And you tend to find, probably less so right now, but normally you tend to find that you get a premium on exit when you come to sell it. And as all the big institutional owners look to scale, both the public REITs that have gone out of Germany into places like Sweden, some of the other markets, and similarly the private investors that are all trying to get to scale and just build up big teams across Europe. They're desperately keen to buy big portfolios and pay for the hard work of assembling. So I think, yeah, if you know your local markets and are willing to look beyond the core German, Netherlands, multifamily markets and into some of the more peripheral markets or newer markets, you can do very well playing into some of those European industry trends.
Like maybe one theme or what? Sorry, Hans, go on.
Oh, thank you, Stan. So it's great to be on a panel that we're on here today, comparing the US and Europe, because there are some opportunities, especially here in the States, for differentiation that I think are really occurring more so in the last couple of years. Will be a big part of the 2020s. So if you look at heaven, where you'd want to live, it looks a lot more like, I would say, London or Amsterdam than it looks like Midtown Manhattan in terms of walkability, but not overwhelming in scale. So there are a lot of opportunities for mixed use development of the type that millennials really want, coming from these urban environments to the places where they want to be. And it's interesting that this is occurring just as the two biggest trends in the built environment in 2020 are, first, not enough housing, and this is something that happened on both sides of the Atlantic, and especially here in the States, way too much retail. So the redevelopment of retail into mixed use environments that are the type that millennials want, I think is an opportunity for developers to differentiate themselves and really tie into what people want. So there are operational opportunities of the type that Caleb describes, better operations, more institutional. I think that applies especially in scattered site single family rentals, where the institutionalization of that sector, operations make a huge difference. But there's huge opportunities that really tie into the greater currents of the US. And I would add to that, development is another differentiator. In an environment where so many assets are trading at or above replacement cost, and we've got to develop a housing crisis without enough stock, I think for all of the managers on the line, development is an opportunity for both differentiation and tie into the overall trend. So, sorry, go ahead, Stan.
Yeah, I had maybe a different idea, and I'll just maybe cover this in 20 seconds, which was collection of data. We were all saying how kind of operationally driven actually residential could be. It's a lot of tenants, a lot of small screws that you need to turn right, and you can create a lot of value. Finding a tenant, reducing your voids, doing your capex or apartment refurbishment quicker while tenants are in, thinking about smart capex that can allow you to maybe reduce energy costs or improve the tenant sort of amenities and charge higher rents, financing, etc. And tenants moving in and out every day. And so if you have good data and you invest into your data collection, measuring your voids, measuring every line item of your P&L, etc., I think that is what you probably need, and which is, I think, also a good sign of a good operator, especially in Europe, where there's fragmentation, less institutionalization of the markets, and then also less data available from public sources. I used to work in an American investment bank a long time ago in the real estate advisory space and financing space, and I was always amazed how good data and quality data and long dated and granular we could get from the real estate space and resi space in US versus Europe. So in Europe, you need to have your own data and scrutinize it and survey tenants all the time and challenge and then make decisions out of that and improve.
Thanks all. I appreciate all of the input there. Obviously, there's a lot to discuss, and we could probably have a whole session just on that. I do want to get back to the audience questions. We have one related to what a particular attendee is seeing in terms of a rise in bad debt as rents continue to rise, coupled with rising inflation. They're asking, do you think rents will correct or reset in any way, given consumers are facing high costs in various aspects of life and may not be able to afford the high rents? Maria, do you want to start with that one?
Sure, I can probably offer very high-level remarks, and I'm curious if the panelists can offer maybe more life examples here. But I would say that, yeah, I think tracking wages and sort of given the inflationary level is very important. And what we sort of discovered within our capital markets team is that in the U.S., private sector wages actually fell 3% over the last 12 months, like I suggested for inflation, obviously, as of June. And depending on what period you're comparing, if you go maybe 20 years back, you'll see that, again, rents may have increased maybe in the range of 15 to 16%, and actual adjustment for inflation incomes may have only gone up 5%. So you certainly see that that maybe this income to rent ratio and this magical 30%, I guess, that everybody's focused on is kind of getting there very quickly for a lot of folks who need to rent. So yeah, I would just say that from, again, what I hear, that almost half of the American renters now are in that 30% category. And with rising costs for everything from groceries to basic staples to gas, I think that will quickly become a bigger problem. I have not yet heard from any of the GPs I talked to about that particular comment about rising bad debt, but I can certainly see how that can become a problem, and that will need to be addressed. So I'll just kind of leave you with those macro data points. I'm curious to hear what the GPs are thinking on the call about that.
Yeah, I agree, Maria. I recall when COVID first hit, there was a lot of talk of collecting data on monthly rent collections, and what you saw within that data is actually not a lot of this, but obviously that was a US view in terms of those surveys that were conducted. Caleb, Stan, curious if either of you are able to share the European view on that.
We'll focus in Europe, and curious to hear maybe from Hans what we're seeing focus on Europe. I was curious to see what is in the US, given the specificities we already covered between the two markets. But in our portfolio, where I'll start, which is 10 European countries: UK, Netherlands, Germany, Czech Republic, Poland, Norway, Sweden, Denmark, Finland, and Iceland, we don't see really a rise in bad debt at all. I think a few panelists mentioned this earlier today, that the various level of regulation and support from governments, which proved to be there during the COVID times, is there even today. So we think that people will stay in their homes, will keep paying, will maybe reduce other more discretionary pockets of their expenditures, but we'll make sure they pay the rent. And so in the key markets where what we are talking about, which are the markets where there's a supply demand imbalance and good employment market and maybe a positive migration or household creation, and if you stay in the mass market, what do people do? Where would they move? Would they move out of their job? Would they move into somewhere else? Is it going to be cheaper? It's going to be the same price, if not more expensive, given the inflationary environment. So we think that people might cut back on their sort of discretionary expenditures, as I said, but will keep paying rents. And the risk that we see in the sort of the NOI or the income component of our return is that temporarily rents may grow slower than inflation, and OPEX may grow faster. Due to regulation or due to just affordability and sort of social aspects of it, etc. But not that rents would drop or that people will stop paying rents.
I'd agree with Stan. I'd say the other thing that makes Europe just a little bit different is when you're in and you have your rent, it doesn't increase with the market rent. So you kind of, if you stop paying your rent and lose your security of tenure, you lose your ability to stay in the flat, then all of a sudden you've got to move somewhere else where the rents are a lot higher. So you'll give up your car before you give up paying rent on your flat. So we have a slightly different dynamic in that respect. You often see when you relet the space, a 20 to 30% jump in rents. So, but the rents are fine. The issue is also is the OPEX, as Stan says, but also if you look at the vacant possession values, we are very sensitive there to swap rates. Cost of financing, availability of finance are the biggest factor for vacant possession values for condo prices. And ultimately, there is a connection between multifamily values and vacant possession values. So although the income component may be okay, we'll probably see an impact on the capital value side of things.
Stan and Caleb make some very good points. And while it's not exactly the same here in the States, it definitely rhymes. And so it would say, to lean on some statistics that Maria brought us to earlier, if we look at the average monthly payment on a single family home for that core 30 to 44-year-old cohort that's growing so quickly, over the course of the last 2.5 years, between the increase in interest rates and the increase in prices, that monthly payment's gone up 71%. Now, during that same time period, the average rent for the average US flat has gone up about 23%. So the 23% that you see in the news is quite dear and painful as a renter, and quite a good position to be in for all of us on the call owning apartments, but it's nothing like what it's been in the for sale housing market. And at the same time, the down payment required for the average US mortgage has gone from about $50,000 to about $70,000. So almost unaffordable to very dear. So to the point that the other panelists have made, the question is, well, what else would they do? So, that you could get to the point where you can't get blood out of a stone, that 30% number that Maria mentioned earlier, that can be problematical. And the flip side is if we start to see some more regulation on rents, which I think that there are 3 or 4 more municipalities here in the States that could introduce more rent control in the future because the rent rises have been so dear. But overall, we think it's a good position. And if we look at trade outs and rents, on average, what we're seeing in the single family rental space is rent growth for folks that stay in the same home at about 8% versus market increases about 15%. And that provides a lot of padding upon renewal if the market comes down.
Thanks all for that. We've kind of danced around this subject, but haven't addressed it directly. Curious to hear how you all are thinking about and underwriting rent growth, given some of these pressures that we've discussed. Maria, do you want to take a first stab at that?
Sure. Maybe quickly, obviously we talked about the rent growth and how challenging it may be, I guess, to really underwrite it going forward. I think another part of this equation is just cap rates. And again, what I hear in the market right now is that just given the pure increase in financing costs, cap rates have expanded somewhere in the range of 50 basis points, but that's like very average and not super specific to the market and the specific property type. So I am curious what other panelists think about repricing, because another point I'll just make is that what I hear again is that uncertainty has brought more rationality. So if developers in the past were able to, quickly build something and sell it to the next value add buyer without necessarily stabilizing the asset, right now there are a lot fewer of those participants ready to take on, half stabilized apartment building. Like there needs to be more stabilization and the risk needs to be priced. And with how cap rates are relatively low, I think spreads to the 10-year treasury, I'm just again curious where is it all going? Because valuation is a big question. So I'll stop here and see maybe what my co-panels have to say about that underwriting that they're using.
I think one maybe answer to how do we underwrite in today's environment, and not just rent, but the rest of the components, the OPEX, NOI, and financing going forward, valuation spreads to government bonds, etc. One answer is that the market actually, as a result, is stuck. There's not much happening, at least in Europe, for the last couple of weeks and months. And I think it's also on the public market that the trades have gone down, the share price has gone down, but not on a lot of volumes. But especially in the private market, markets are stuck. There's a bit of a standstill, and that's because of the difference of views on value and the cash flow projection between the seller and the buyer, typically, where buyers see and need to be cautious for what's coming up. And we mentioned the rental growth may not be compensating for the operating cost growth in the short or medium term. Obviously, higher financing costs than 12 months ago. Some uncertainty in valuation yields. Some have already expanded, and the supporting VPV or condo sales values already under pressure, and depending on markets, maybe a bigger question mark or small question mark, certainly not growing, and probably on a small kind of downward trend. So what this has caused is just stop the transaction market for the time being, and let's see the next couple of weeks and months what it does. But certainly on the buy side, I think we'll be more cautious on all the line items, and as a result, we'll be looking for deals at the same or lower price, obviously apart from sort of specifics and value adds and redevelopment and this and that, where we take operational risk or redevelopment risk. But curious to hear actually what other people say.
Yeah, no, I agree. It's a very tricky time with a lot of change, and we think about it as equity providers. There's also the banks who we're seeing real time a shift in not just the cost of financing, but the availability of financing that's really having an impact on asset values ultimately, and what we can pay for them. In terms of rental growth, it's a tricky one. You have you've seen free markets in Europe become regulated. It sounds like Maria, based on what you were saying, you're seeing that in the US as well. So places like Ireland used to be completely free market and now have rental regulations in place, and that, so we can underwrite what we think will happen under the current regulations in places like Germany, the Netherlands, the current regulations. But what we're seeing is, all in reaction to coronavirus and the housing shortage that we're all facing, there's been this implication of rental regulations onto the market, and it's very, very hard to predict that. You can just have a hunch about it, but you can't predict it. So we're generally trying to just steer away from having to judge that sort of more political question and go into the freer markets where we can capture rental growth more assuredly, like the UK and Finland and places like that. But even then, there's a question as to how much the tenants will have the capacity to pay. Will we be able to keep up with inflation or not? And so we're generally assuming that we won't be able to keep up in real terms with inflation, be behind it. And in terms of market pricing, it is very hard at the moment. You've got the listed market of 30% on GAV, not NAV, but on a GAV basis. We are seeing generally the market's frozen, as Stan's saying. We are seeing one or two transactions happening here or there, and they aren't down as much as the listed market. I can think of one in Germany that's probably about 15% off where it was before. There's something in Ireland that's traded only a few percent off where it would have been before. And we're seeing approaches in some of our own assets. Actually, interesting, our own portfolio is giving us very idiosyncratic data points, where we're actually getting surprised still at the level of pricing that's out there. But it's a very hard to read the picture, and so like Stan, I think we're all just being really cautious as to what we do right now and being very prudent with our capital, as our lenders are as well.
Before we wrap up the first session, I'd love to get the panelists' main takeaway from the discussion before we transition to the second session. So Caleb, perhaps we'll just keep it with you in case you're still off mute, and get your main takeaway.
I think my main takeaway was probably the positive underlying fundamentals that exist across both the European and the US markets in terms of lack of supply and demographic demand, as long as you're in the right markets. And so perhaps despite all the uncertainty right now and the implications having, maybe now could be an interesting time to invest, because you'll benefit from that uncertainty but still have those good long-term fundamentals. So I think that was my key takeaway, and I was surprised at how common it was across the two. I thought there'd be more supply in the US, so I was actually surprised to hear just how supply constrained it was in the US as well.
Hans,
To build on,
yeah,
sure. To build on that, I would agree with what Caleb said. Housing is one of the few areas in the built environment where we have a shortage that appears to have staying power. That's going to be with us for several years. That's very attractive for the built environment investors, and it's large enough, so it provides opportunity to put a lot of money to work. That's attractive. And then secondly, we believe, and I think most of the panelists would agree, it's one of the best inflation hedges. So incomes from apartments is best correlated with household incomes. So it's an efficient way to transfer inflation into NOI, and it's got staying power in terms of demand for the asset, which is different from some of the other property types which are in a tough spot.
Thanks, Hans. Stan, and you?
For all the reasons that Hans and Caleb have mentioned, we're very positive for multifamily in the medium and long term. The fundamentals are strong, and where we and the concept of actually accommodation and a bed and a kitchen and a living room has not changed much as an operating concept in the last 500 years. So it will stay with us, and people will need these. And with the package of information from the markets and from the macro and geopolitics we have today, we expect short-term volatility in valuations and stickiness in the transaction market. We don't expect a crash because of the strong fundamentals and so many kind of potential buyers of multifamily housing and relative soundness of also balance sheets of the various sort of components of the market. Speaking about Europe. The owners, private and public, large, small, the developers, the banking system exposed to residential and the undersupply. So probably a better shape of the market than 14 years ago at the beginning of the global financial crisis.
And finally, Maria.
Yeah, I'll be very quick and over time. I'll just say that I don't think multifamily going out of favor anytime soon. I think that leverage and moderately leveraged real estate overall in the U.S. so much different from the GFC time. So I think there's just more buffer there in case there's an additional market correction. I would say you have to constantly kind of watch the market and understand what you own in your portfolio, understand secondary markets, why they're secondary, right? Because maybe prone to overbuilding, and how sustainable some of those demographic shifts throughout COVID. That all needs to be evaluated, I think, individually. So yeah, I think overall it's positive, but I think it's changing daily.
Thanks, Maria. Much appreciated. Want to now start our second session, which is focused on specifically defining opportunity sets in selective markets within the US and Europe. And before we transition over, just want to thank you, Maria, for your time and all of your comments in session one. And then David Dix, want to ask you to please introduce yourself and apply a bit more pressure to our manager panelists. So David, please.
Thanks, Nick. Bye, Maria. Nice to hear your comments. Hi, everybody. My name's David Dix. I'm a partner with the Townsend Group based in London. I've been working in the real estate industry, just trying to tot it up a minute ago, about 25 years. I started in Australia. I had the pleasure of touring an Archstone Smith residential development in about 2003, or about 10 of them actually, and was completely blown away. So that was my first touch on residential. I then was the CEO of a listed REIT owning US shopping centres based in Australia. I then worked in the private markets in real estate in Japan, and now back over in the UK managing indirect portfolios for Townsend clients based out of London.
Thank you, David. Now to put you immediately on the spot, how should investors think about multifamily in a diversified portfolio, and has that perspective changed at all over time?
Yeah, sounds like a teed up question, Nick. Look, yeah, it's an interesting one that, there's a lot written about how to construct diversified portfolios, and I don't have a keen sense for the audience here. But when we think about it for our global clients, we're constructing global portfolios. And there's a difference between how would you do it in a perfect world versus how do you focus on an investable portfolio. So as soon as you add that word investable, the whole picture changes. Residential is really interesting. As I said, when I was blown away as a young bloke looking around those Archstone Smith properties, the US market was clearly hugely developed. If you got outside of it was completely non-existent in Australia. As I discovered, it was enormous in Japan, and in Europe it was huge in Germany, but very small elsewhere. And so if you look today at the investable markets, and if we define those as essentially, MSCI defines that stuff, and you see that around 2007, roughly speaking, the housing stock, of investable, the universe, about 14% or thereabouts was residential. And this is, you shrink this not to the total stock, but through funds. Again, these are approximate proxies. It's grown to a bit less than 20% now, but again, that's very focused on the US. So the US represents the biggest opportunity, biggest investable market. And as we've been hearing a lot about in the last hour, Europe is growing at different paces in different places, but certainly growing. And it's starting to flicker in established institutional markets like Australia. It's huge in Japan, but in parts of Asia Pac, but that's very much further behind. So we look at the investable part and then reflect that in our kind of diversification. So as we've talked about, I think, residential has the honor of being the only real estate asset class thought about by Maslow in his hierarchy of needs. And clearly it is the only one where the occupier would view it as essential. So it should have a part in any portfolio. I think the importance of that will grow over time. But the other thing that's worth noting then is, if you look at investor surveys over the last couple of years, I think for the last 3 years, industrial and logistics and residential have been the one asset class that most investors have prioritised over all others, if you look at most of the investor surveys that come out. So in diversified portfolio, it's there at the moment. It's probably there at a benchmark holding of around 20%. It's a pretty unsophisticated way to approach it. But the final point I think I'd add on that is this is nice when you say, well, what's my allocation of residential? You need to then think about geographies. You'd be biased towards the US and then to an emerging extent in Europe, as we're hearing. And then finally and crucially, and I think this is where it gets really interesting, and you've been talking about this already, then locally. So, while the US market is still the biggest, exactly as I think was said a few moments ago, the European market is not one market. It is a multiple markets with all sorts of different considerations, particularly around regulation, and even in markets, as Caleb was talking about, say, for example, the UK, where there isn't formal regulation, there is almost informal regulation through difficulties around planning and stuff. So you're then looking at investment selection. It's all about people who can execute in those markets, and then it gets even more fun.
Absolutely. Thank you for that backdrop, David. I completely agree. Hans, as we touched on some of the higher level macro trends in the first session, would love to dig a little bit deeper into more of the country and even city level trends that you're seeing. Can you please start with your views?
Sure. So first of all, I would say we're expecting the rest of the 2020s to be much different from the last 2 years and the last cycle. So the last 2 years have been just a magical, wonderful place for anybody who owned anything residential. It almost didn't matter where you owned it, and because it had demand growth. As I mentioned earlier in the panel, incremental demand growth from people either decoupling, they got away from their roommate, got their own place. So that was demand growth that didn't require any new people. And we had more work done at home. And with the acceleration of the millennials starting to make decisions that they'll be making over the course of the next decade. So it's a wonderful time. And it explains a lot about why places like, I mentioned Akron, Ohio, or Cleveland, or other places had demand growth when they didn't have any more people. Well, what we could be seeing over the course of the next couple of years, and over the course of the next, especially 3 to 5 years, is a flat spot in markets like New York City that people are not moving to. People are euphoric about markets, coastal markets like New York City right now, because the demand growth has come back, because rents are higher than they were pre-pandemic. And that's great, and it's all a function of these things. But it reminds me of all those years when all of us in commercial real estate said, I'm gonna buy in Midtown, I'm gonna buy an office building, because there's always demand for Midtown office. Now, some of those buildings on Lex or on First, the barriers to supply aren't filling the buildings because the people aren't filling the buildings. Why do I bring this up? Most private equity investors own assets between 5 and 7 years. So demographics over that time period matter. And historically, there was demand growth to be had for everybody in every market in apartments. And the question was supply. We still need to be really cognizant of supply. But increasingly, we need to be more concerned with demand than we were historically. Last 10 years, a lot of the demand growth in apartments was the 25 to 29-year-old age group, which was growing at, on the order of 1% a year, and people were migrating to the cities. Cumulative demand growth over the next 4 years in the 25 to 29-year-old age group is a negative 1.3%. That's not a positive thing. That's on average. Some markets do better, some markets do worse. So overall, I think the number of bodies starts to matter more. Supply. Over the course of the last 20 years here in the States, if you've got a not good public school district, you can build as many apartments there as you want. No restrictions on supply, really. That's what we found in these high barrier coastal markets, but really everywhere. Over the course of this economic cycle, that may still be true at the same time as you can't build in average or above average public school districts. And that creates a mismatch with demographics. So I think it's going to be a really exciting time for the average investor who's holding on for 5 to 7 years when, yes, we need to be careful of supply, but we need to be careful of demand in a way that hasn't been true over the last 2 years and certainly wasn't true over the previous 20.
Thanks, Hollins. Before I hand it over to the other panelists, I do want to address one of the questions we received earlier about the Sunbelt markets specifically and whether that past performance can be sustained. And then furthermore, your thoughts regarding the impact of work from home on different multifamily markets and the urban versus suburban debate. So sorry, just threw a lot at you. First and foremost, Sunbelt market performance, work from home, and then urban versus suburban.
Well, if we look at the Sunbelt markets or the hockey stick markets, as we call them, taking into account a different group, bringing in Seattle and Denver and Salt Lake City and taking out some of the other traditional markets, that demand growth appears to be fairly robust. When people are in their mid-30s, they become concerned with really boring things like, what am I paying in taxes? Can I afford to buy a home? So these things really benefit those markets. But as I'm sure everybody in the panel will comment on, that's where we have a lot of supply. If we look at Nashville, Salt Lake City, some of these markets have on the order of 10% of the inventory underway today. That's a 5% addition per year. That is a lot of supply. Some submarkets won't withstand this, and some will. So I think that on a top-down basis, we're looking for, does the market have growth relative to its supply growth? That's on a market-by-market basis. And then, as I'm sure a lot of the other panelists do, we look at it on a zip code or on a 500-meter radius basis based on myriad data. And really, at that point, you need to get a lot more detailed. And I think the urban-suburban debate is exactly on point. And I would also mention that if we look at the inventory of apartments here in the States, there's some markets like Seattle where on the order of 80% of all the apartment units that were built over the last 12 years were studios or one-bedrooms in the urban core, and not much more in the way of 2 bedrooms, even outside in the peripheral shoulder markets. So what we've built the last 12 years is not on the margin what the core demographic wants. So migration, format, submarket, all of these things matter, quite a bit. So it's a little hard just to say urban, suburban, submarket. There are a lot of moving parts, but very much look forward to seeing what the rest of the panelists have to say.
Thank you, Hans. We'll turn it over to our European counterparts. If you guys want to address, obviously not the Sunbelt component, but more so work from home and how that's changing your investment thesis.
Work from home is interesting. When it struck in COVID, you saw this sort of emptying out of the big urban markets and also the expat markets. And we, particularly so in our portfolio, we had generally performed very, very well. The one area where we had some difficulty was in are micro living apartments, which tended to be occupied by more expat occupiers and sort of younger professionals who relocate. And that was the area where work from home meant they could go back to wherever they originally come from and work from there. And so that really made us suffer there. It's been interesting post the sort of reopening of the world. Actually, some of those markets that suffered indirectly from work from home have really actually now benefited as people have gone back into those big urban metropolises and started leasing again. We've seen this big jump in rents in those markets. And so over the long term, we're still much more focused on the supply demand dynamics. Generally in Europe, supply is far more limited, but there are markets which are better. So the UK does very, very well. Sweden, a market Stan knows very well, does really very well over the long term because of those supply constraints. And David referenced the UK actually as well. It really, if you look at the data, they grow 7-8% per annum over the very long term, over 10, 20, 30, 40 years. So we still focus much more on that. What we are seeing is in the properties, the physical aspects of the properties are having to change a bit. So you often need more co-working space because multiple occupiers are sharing a space. And all of a sudden you find them sitting out in the lobby areas trying to work remotely because there just isn't enough space inside the apartment. So now when we're doing something, if we're doing a new project now, and it was a ground up development, or even if it's an existing building that we're repurposing, we'd think about whether we could put more co-working space. And I think that's one of the biggest impacts on the physical real estate for us.
Stan, David, anything else to add on that one?
Not really, no. I think it was very comprehensive. I could say the same thing again, but I won't.
No, I appreciate that. But David, perhaps while you're off mute, perhaps you can touch on which markets specifically in Europe are you most closely focused on in terms of which are performing well and going forward.
Yeah, look, I'm going to, well, probably perform as expected and not give you a specific answer to that, but talking generally, I think we've talked, a number of people have talked about the shortage across all the markets. It varies. So, there's a lot been written recently about what's happening in, Germany seems to be potentially priced under pressure. But the way we think about it generally, because remember, we are typically always investing indirectly at Townsend. So when I'm looking for my clients, it's invariably through fund structures or sort of commingled structures. And that often has an element of diversity built in. But I think what we're looking for is, and this point's been made a few times, but it really is, I think, crucial in Europe, is operators who understand their local markets. But then I think Caleb made the point earlier on that while that's really crucial, it's also helpful when you've got pan-European operators who can, defray costs or manage across different geographies. So we're not so much focusing on individual markets and ruling some in and out, although we're cautious on a few, but generally speaking, we're not taking that position. But we are very discerning when we're coming to managers, big operations like Heimstaden who have track records of success in executing at a very granular level across multiple markets. And I pick Heimstaden out, but there are others. And that's really key, I think, because it is a very different market depending on which particular part of Europe you're in.
Thanks for that, David. And sorry about that. Stan, curious, given you're in so many different European markets, what do you typically look for when entering a new market, in addition to a lot of the supply and demand drivers that we've touched on already?
Not trying to repeat what we kind of said in the last 15 minutes and also on the previous panel that I attended an hour ago. And trying to kind of continue expanding the themes that Caleb, Hans, and David started on this panel. When we enter new markets, I think those are specific questions, and I'm honoring this. We're looking at investable product and critical mass that we can gain so that we can operate in a way that we are happy with. And coming back to what I said the last hour, is to to own our data, have our people who monitor exclusively, subcontract, or do themselves the leasing, the calculation of the void periods, the meticulous budgeting of tenant improvements upon churn, capex upgrades to energy saving, tenants comfort, reception areas, normal maintenance, valuations, financing of assets, etc. So we're looking at a prospect of having critical mass in a particular market, and the markets are different. So we are looking at the larger market first. We are in Netherlands, Germany, Czech Republic, Poland, Finland, as I said, the Scandinavian countries, UK. We have currently the mandate to go to other European markets, and if we were to go somewhere, it would be one of the markets where there's a number of larger investable cities which have those fundamentals that everybody has been talking about, but also have potential investable stock, either existing or to be developed, so that we can actually rationally own our own operations and roll out our not just the kind of the operations as a service, but our, I would always call ourselves, and even more so since COVID, we're trying to be a data mining company. We're trying to scrutinize and collect data and survey tenants at every stage of their relationship with us, and learn from that, and learn from what we kind of collect and challenge ourselves. If we need more amenities, do we need to kind of help on energy costs? Do we need more space or less space, more studios or more 3 bedrooms? And if studios, do we have convertible sofas and beds, and are people able to pay €1 per square meter more for this, etc.? So I think what we're looking is at also some sort of a critical mass when we enter a new location, so that we can have the full suite of our operations and the data mining that we like about the resi space.
Thanks, Dan. Not sure if this was intentional or not, but I think you hit on all 3 components of ESG within that response, and that was an area that I was hoping to get to. Caleb, what impact is ESG having on multifamily investments, in addition to some of the energy savings and tenant engagement that Stan just referenced?
Yeah, ESG is interesting in Europe. It's a much bigger focus from the investor base on ESG. And in fact, we've got a big suite of regulations coming in called SFDR, which is really going to have an even greater impact again. And as a result, particularly for the E, which is very well defined within the market at the moment, there's a huge focus on getting to net zero pathways. And so that's every asset that's coming up for sale. You have to have a pathway to be net zero. You don't have to be at net zero, but you've got to have a pathway to get there. So it's become part of the investment fundamentals, much like leasing and renting out and controlling your operating costs and upgrading the properties has been. It's now become another dimension to your investment. At the market level, there's also some impacts as well. The regulations coming in different countries, and some of them for the positive, some of them for the negative. So places like the UK have introduced minimum energy efficiency standards, which are going to ratchet their way up. And so the result, that's fine for institutional landlords, but for your private buy-to-let investor, they're going to be faced with investing money to upgrade the property, which may not come through in the vacant possession value, so they won't get a return on that investment. So potentially it's going to take a whole load of stock out of the market. Institutional landlords will have to invest in their properties, but at the same time, there'll be a whole load of competition coming out of the market. So that could, in some ways, be positive for the occupational side. And then you've seen in other countries, you've seen some positive trends in terms of subsidies to improve your properties coming in as they look to increase energy efficiency, and so it goes on. So it's been a really mixed sort of impact from it all, but it is now becoming a fundamental part of investing, which is interesting. The S and the G, less so. We have partnerships with groups to provide affordable accommodation for disadvantaged tenants, and through initiatives like that. But the S and G is still a long way really behind the other bits of the market, other than perhaps just the focus on whether rents are affordable. That's the only real bit that's coming through at the market level, but is predominantly an E question at the moment.
Nick, can I jump in and ask a question of Caleb? Am I allowed to do that?
That's
of course,
fair,
please do.
Yeah. Sorry, Caleb. You can push this one on to someone else. One of the things that's interesting to me, and on the ESG front, is if you look across all the other sectors, it's if you're not in, it's a huge priority in Europe, really, in all sectors for all sponsors and all responsible sponsors. And we get asked the question occasionally, is this ESG stuff that you're doing financially important? And you say it's financially essential. It does occur to me, though, that when it comes to residential, there is the potential for the sponsors of institutional portfolios of residential to have more binding commitments, if you like, and greater sort of collective focus on this than the mass of their tenants. Not because the occupiers, the tenants don't see ESG as being important, which they probably universally do, but at this time, in this place, people don't have money to spare, and so they're not able to pay higher rents for better ESG performing buildings. Can you comment on that?
It's probably compared to something like offices, where the tenants have a huge focus on it. I think there's a good degree of truth in that. I wouldn't say it's completely irrelevant. It's just not. It's not relevant in such a direct tenant choice way. It's more of an indirect tenant cost sort of way, which is. So in the Netherlands, we refurbish a lot of units and upgrade them, and we put in insulation, and that has a benefit for us when we sell the units, because the investors want to see that net zero pathway, but also it has a benefit for the tenants. You get improved sound insulation, you get better energy efficiency, and so it goes on. In some of the markets, we actually bear the operating costs for the energy directly rather than indirectly. We directly bear those costs. So for those markets, you get a very instant yield on capex that you get, and so that's the second sort of financial reason for doing it. And there's a third one, which in some of the markets like Germany, it's tied into the rental regulation. Actually, in the Netherlands, it's tied into the rental regulation, where if you put the money into the capex, you're often allowed to then increase the rents or accelerate the rent increase, and so you can get a direct payoff. But I think it is the overarching theory that it's probably less relevant, say, in an office building to the end tenants, or less directly relevant, is probably still true. But the end investors do care about it. You can't really sell a residential asset.
Sorry, Nick, I'm doing it.
True, but it's coming true that you can't sell a residential asset without a net zero pathway. So yeah, it's driven as much by the capital markets as it is by the occupier markets.
I'm doing Nick's job here, but
so go.
Yeah, no, it's interesting. I was going to say, I wonder if that's Heimstaden. I'm sure that is Heimstaden's experience, but is that right?
I think very much so. Maybe a few more points on top of that. Agree that in comparison to commercial real estate, where ESG agenda has been driven by occupiers and tenants, in resi space, tenants did not care so much up until now. Now I think they'll be more focused on energy, so the E part of ESG, because of kind of the extraordinary inflation pressures on energy, and but it's coming from the capital markets, the owners, and the debt capital markets, not just equity. And for the tenants, I think there's not much, apart from energy costs, there's not much sort of transparency either. The taxonomy, the certification level, and kind of the depth of the intellectual sort of background behind any certification in resi space is not very big. I mean, BREEAM and LEED certificates and these sort of certifications are coming, but it's only very recent, and we are trying to do all of our buildings that we refurbish or that we have built for us as BREEAM very good or excellent. But it's coming only now, and it's recent. It's driven by, I think, owners and the transaction market. That being said, we are pursuing this because we think that it's not just it's not just saving costs on NOI for energy indirectly or directly for the tenants or for ourselves, but the S&G can, over a longer period of time, have also an impact financially. Being a good landlord and socially responsible for your communities and your surroundings, and taking care of the outer space, for example, can make your brand and your tenants to be more sticky, less churn, less operating costs, taking better care of their neighborhood themselves, even though they are occupiers, tenants, and not owners. So we are believers that it's worth going ahead of our tenants and push the ESG agenda, not just E, but also the S&G, and probably educating tenants is pompous and not, it's a bit out of place, but be a leader, and there will be a financial return in S&G as well.
I'd throw in just one more thing if I can, triggered by what Stan said, which is one of the tensions is for the older stock, you can't get the same excellent BREEAM, well, the BREEAM rating often isn't even worth it because they tend to be smaller properties, but you can't get that same excellent rating. It's obviously much more efficient to take existing properties and upgrade them or maintain them, and it's to build something from the ground up where you have all the embedded carbon in it. And so it's a tension in the market. Will the end core buyers be happy with an older building that's being upgraded, or will they pay that premium for the brand new building that has the excellent BREEAM rating? It's a tension in the market that's out there at the moment.
The old engagement versus divestment discussion. Hans, since we've gotten the European view, obviously we're a bit behind in the US, but it's coming. It's becoming more and more important. Would love to get your take on ESG and what you're hearing from investors.
Well, it's an interesting time in ESG here in the States, even in residential. As the other panelists pointed out, it's less front and center in residential than it is in office. In office, for LEED certified mixed use space in good locations over the course of the last 3 years, occupancies have been exactly stable. There's been no decline in occupancy. Whereas for the average US office property, occupancies are down about, say, 4 or 5%. So, we're seeing it actively underway in terms of tenant demand in the office sector in ways that we're really not in residential. But I would say that that's changing. Not so much from the tenant side in terms of seeking certifications and the taxonomies that Stan mentioned, but rather a couple of things. One, the costs. So to the extent that tenants are bearing costs, that's front and center because there's general inflation in energy costs over the last couple of years. But it's not necessarily in the rent for the unit. It's for their commutation costs. Most Americans commute in their own car. If in mixed use developments, which are typically more infill in nature, they tend to have shorter commutes, which can drastically decrease their car costs. And they also have quite often they can take public transportation. So when we look at mixed use developments, the lease up periods are much shorter on new developments. The rent premia are higher. And part of it is that you're getting part of the tenant savings from their E-focus on energy, less so on the S&G. So while it's not completely obvious with residential in the States, it's definitely underway. What is obvious a little bit more over the course of the last week is the recent federal spending bonanza. All that spending is supposed to cut down on our inflation, or so we're told. Well, the good part of this is it's oriented towards decreasing energy consumption and specific incentives in that program to decrease GHG emissions from buildings. And the payoff, there are some incentives in there that I think are going to incent a lot of tax-driven investors, and which are typically smaller, medium-sized buildings here in the States to pursue those programs. And there could be some ways for non-tax-driven investors like those on the call to take advantage of that too, depending on structure. So I think there's a non-intuitive way that it's playing out that's different from Europe, and I think that there's an acceleration we're going to see as a result of new regulations.
Thank you for that, Hans. Certainly touched on regulation pretty much throughout this conversation, but would be curious to hear from the panel in terms of other risks that you're thinking about, not just at the kind of regional level, but city level risks in addition to regulation. So David, perhaps start with you in terms of risks that you're viewing, not only in terms of your investments, but what you're hearing from your investors in terms of the investments that you are making.
Yeah, it's a tricky one. I mean, the risks, I think, are just really the major risks we're concerned about across all the sectors at the moment are macro, frankly. We see the emergence of a number of good managers in Europe and in other markets too, actually, as I mentioned earlier in Asia Pac. I know it's not a subject here, but we've got relationships with some excellent managers in the US in Resi, but the big concern is just around macro picture. Everything's getting more expensive, everything's getting more complicated. That drives through to rental growth, and where does that leave you in terms of total return? And so really that sits across everything. I know that's too general an answer really for this particular panel. But then when we look at European residential markets, I think I've already answered this question in a different way elsewhere, which is we look to de-risk by going with managers who have the ability to execute, not people who are looking to aggregate. And I think also, that doesn't mean that we're always necessarily going to be drawn to the biggest players in the biggest markets either. We'll be very alert to the opportunity for smaller asset managers and smaller developers who are doing particular things in markets that are meeting a niche. So if we expand residential to include things like aged care and senior housing, beds, as it's more broadly talked about often, that again, whole different topic, right? Not multifamily, but similarly, lots of interesting things there. But it is all about, a market like this where there's a lot of stuff flying around and you don't want to get a hit in the head by it. You're looking for people who have got, the ability to hold down as many things as they can and actually, put them in the order that you want them to be in to get a good return for your investors. So there you go. There's another terribly generic answer, but it really is, I think, about execution at the moment rather than letting the market do the work for you and relying on the demographic and economic tailwinds. That we're not in that place.
I appreciate it.
Oh, sorry.
Go ahead, Caleb.
Yeah, I can throw in one other one, which is taxes. This applies a little bit to all real estate asset classes, but maybe more residential than anything else, because they don't want to discourage office employment and other types, and retail's already been hit pretty badly. So, but yeah, residential, we're just seeing taxes in different forms, whether it's ongoing property taxes, or whether it's transfer taxes, which ultimately come through to value. Or whatever it may be. We're seeing as the governments are struggling with their debt burdens, they're just using real estate as one of the areas where they can find tax revenues, and it can't really shift itself to another jurisdiction. So yeah, that's one of the things we worry about.
One area that we haven't touched on today, surprisingly, in either of the sessions, is vehicle structuring. Hans, you did mention, I believe it was you that said that the typical investment life for a multifamily asset is about 6 to 7 years. So let's say a value add closed-end fund was started about 6 to 7 years ago, and you're looking to divest all of these nice, shiny multifamily apartments that you've just refurbished. How does that factor into risk or trying to sell in this market where there are no sales occurring? Hans, perhaps start with you on the US view.
Sure. And as other panelists have pointed out, it is really a pause in the market. If people perceive rightly a lot of risk, we've had an increase in interest rates. People don't want to suffer that in terms of cash on the exit, and the increase, cash on the mortgage. And people are looking for another leg down in the economy. And particularly in the office sector, but also in other sectors as well, the lending market is not as free as it was in terms of proceeds. So really a lot of things working against transaction activity through this year. And we may have seen the peak of it for a while. In multifamily, yes, but all the property types. I think next year, things will start to normalize a little bit more. If we get a recession, interest rates will likely go down. And we see allocations across large investors continuing to favor fixed assets. If we get that recession, the multifamily sector will look comparatively attractive, I think, compared to some of the more pro-cyclical sectors, certainly office, but also hotel and other sectors. So yeah, I think it's going to be slow for several more months. I think there's a lot of caution out there. But to your point, 6, 7 years ago, if you got in 6 or 7 years ago, you're up. And I think there are opportunities over the next 6 or 7 years in terms of being in the right property type, SFR, or in some cases multifamily. It's well located, and over that 6 to 7 year hold, because as the panel discussed earlier, residential is really the best inflation hedge. So we believe that if you win on NOI growth versus the other property types and other investment alternatives within residential, you win. And so I think regardless of what happens to cap rates, and that's really hard to predict, I think residential should be in good position for the next fund life of 5 to 7 years.
Thanks, Hollins. And I know in the US in general, we tend to prefer closed-end vehicles more so than in Europe, but curious to hear from some of our European panelists how they think about vehicle structuring with respect to multifamily investing.
Hans, an interesting point. If you bought 6 years ago, you're probably in a good position. I would also add on to this that 6 years ago, let's say 2015, 16, it was really the beginning of modern build-to-rent development in Europe. It started in the UK, a little bit in Ireland. It's coming throughout sort of new markets to the south, Central Europe, etc. And there's been a flurry of new developments of more amenitized or better designed, better furnished or more furnished apartments. And so if you bought at the beginning, you are well off even today. If I were to buy today in a new build-to-rent development or funding a development by a development partner, I would be looking at the much longer term than 5, 6, 7 years. I'd rather say that I want to make sure that I have financing and an entry price and a strategy to attract tenants over a longer period of time, and I don't have to exit in the next 5, 6 years. The construction costs have come up; they are not coming down, at least not coming down quickly. Land prices are quite sticky as well, especially in the places where you want to be with your resi stock. So I would think that longer term capital is better suited to continue pursuing multifamily, especially today in sort of short term valuation and financing cost and availability volatility market. Having a short duration closed-end fund, I would be a bit more cautious.
Thank you, Stan. Appreciate that.
I'm quite happy to take the other side of that. I think it depends on what we're trying to achieve. So I think it is a great long-term asset class. There are some well-established European open-ended funds for both individual German, Dutch markets, but also pan-European core funds, which produce moderate returns and perform very well over the long term. We run very long-term separate accounts for some of our very big institutional investors where they're similarly trying to just achieve solid income growth and capital appreciation over the long term. And that's a very, very good place to be. Equally, though, we run value fund series, which have historically performed very well through doing much shorter term plays, and they can capture shifts in market dynamics very well. And particularly in Europe, where it's so complex, as we were talking about before, between the regulations, the lack of institutionalization, and the ability to play within different markets in different ways, that we've certainly found historically you can do very, very well taking advantage of short-term dynamics and short-term opportunities that some of the institutional investors can't quite, even in their own domestic markets, sometimes can't quite capture. And I just said in a time like this, that's probably even more true than it was 3, 4 years ago. I just thought actually now's the ideal time to be trying to achieve value returns. So yeah, I have I think it's different types of capital for different objectives, and I think that's, as with all real estate asset classes, there isn't probably a simple, straightforward one solution for everything.
You know, we all do slightly different things, even though we do the same thing, and get different capital, pursuing a bit different strategy, and that's why we can all thrive. I think our key difference is in timing. As I think both you and I saying in the last 5, 6 years, a lot has happened in the European multifamily space. The level of sophistication, institutionalization, cross-border investment, and investment into new purpose-built resi schemes has been enormous, and a lot of value has been created in the last 5, 6 years. So people like you and I who have been on that wave, I think we're doing very well. Starting today in the uncertain market, I would have a more cautious and longer term capital allocation rather than a shorter term if I were to deploy it in the next 12 months. But let's see in the next couple of years.
I love it. What about you, David? Any ways in which you challenge?
Yeah, I mean, I was just in the interest of saying something different. No, not at all. I think that there's an argument to say, I think somebody said it depends very much on what you're doing, but I think we generally, depends on our investors, obviously. But look, there's an argument, I think, to say that you can think about institutional residential, a diversified portfolio of as being, as close as you can get in this space to bonds. that very, very diversified occupier base, that, the essential nature of the asset itself for the user, and frankly, the pretty low return that you generally expect for that core stuff means that that's where it could sit. But then, of course, depending on the structure and depending on the opportunity, you can go all the way up the curve. But I think if you were talking about the core end of the market, then that's how we would think about it. Yeah.
No, I appreciate that. Another topic that we haven't touched on quite yet is technology. Curious to hear how technology is impacting your multifamily investment, whether it's picking markets, whether it's how buildings are operating, or perhaps even, David, how you're looking for manager selection. So we'll start with you in terms of what technology you're using.
I'm going to answer that very quickly, because then it's going to throw to the operators on the call, the sponsors. But look, the technology that the good sponsors are using is incredibly powerful. I'm going to put it out there and say that some of the stuff I've seen in the residential space is stronger than anything I've seen in any of the other spaces in terms of the ability to identify markets to be in, possibly because there's so much stuff published, they're available, and the use of AI and what have you for working out which parts of which towns and which cities you want to be in. And it's true across all of the sectors in real estate, the asset classes in real estate, but I think residential in particular, because you can get such granularity on who is actually your tenant, not who, obviously, but the type of people that are living in the places you want, and then what developments are happening in those markets. But I'm sure Callum and Stan will have a lot of color on that stuff.
I think I mentioned the word data mining a couple of times in this panel and the previous one. That's actually one of our characteristics of Heimstaden. We're a data mining company, not just leasing apartments, having them built or refurbishing them and maintaining them. And in this way, we look at technology very actively, and actually in three ways. One is with a direct financial impact, so kind of line by line on our P&L, especially on the operating costs. Where can we save by using technology? Can we save on energy costs by optimizing the regulation of heating and ventilation and water consumption, etc.? Can we save on downtime for our key repetitive task of relating apartments, refurbishing, maintenance requests, etc., by digitizing? It's a passionate topic, and I could be talking the whole day and night about that. But it's sort of saving costs on our everyday and longer term sort of working tasks. Second level, which we look at technology, is on the tenant and improving the comfort and knowing our tenant, and then kind of driving rent and occupancy longer term by having mobile applications where they can track their energy consumption, rent, etc. Where you can suggest them things on top of a bit of like an electronic kind of shopping platform, on top of what they could be doing in the area, sending them surveys, improving sort of their comfort and consumption of other services that we can resell to them if we have critical mass, and can negotiate discounts on their behalf for kind of consumption of services, retail purchases, etc. And third would be actually how can we, and that's probably completely different, and it comes with scale and the fact that we own and operate all our properties ourselves and own the data. How can we help property technology company to grow by giving them data, access to our stock and data series on rents, occupancy, addresses, tenant profiles, operating costs, etc., maintenance requests. How can we help them to use our data to fast forward their research and development of their products? And in return, we can get a benefit from modern technology by giving them data and kind of incubate their ideas and having a discount or better priced services from sort of new property technology startups.
Yeah, I think on the operational side, there's not too much more I can say. It's the only thing I'd add is because in Europe, a lot of the rents are fixed under regulations. you can't change it. You sort of, there's a formula and your rent is X, and it doesn't matter what you do, it's always going to be X unless you physically change the property. As a result, a lot of the technology is all on the cost side of it. So either controlling heating costs, repairs and maintenance, you code each job. So you know when there's a leaky tap, how much it should cost to replace the leaky tap. And when you see a variance, you can pick it out. And so a lot of it's on controlling the cost because your rents are pretty fixed. But on the investment side, it's proving really, really powerful. It's because the sector's more fragmented. It's not so much like the office market where you get a lot of the brokerage houses publishing big research reports, but there is a lot of data out there nonetheless if you're willing to invest in processing it, and a lot of it comes from third parties, a lot of government databases, and then a lot of Uber pickup rides and things like that. And so you can use the data right from screening which cities you like better because of the supply and the demand fundamentals. And then as David was saying, you can drill right down into the micro areas within the cities and look at the trends that are going on, which are the areas where we're seeing big growth in the young professionals that might drive rents forward, where they're going out and they're using the bars and the coffee shops open and all the rest of it. You can aggregate an awful lot of data. I'm sure the US, as ever, is light years ahead of us in terms of data. So I'm interested to hear what Hans said, because when I speak to my US colleagues, they're always disappointed. We think we're doing wonderfully well, but we're always disappointed that we can't do half of what they're doing. But anyway.
Well, I think Caleb's exactly right. I agree with everything on the operational side, the opportunities and the constraints. I think that applies equally in the US and Europe to Caleb and Stan's points. On the household data, and there could be something to the way it's being done in Europe, to Caleb's point. The amount of data available here in the States is borderline creepy, and boy, is it powerful. So I think a lot of institutional investors that really put the time and effort into understanding the data can apply it in new ways that weren't possible even 3 years ago. So, one of the databases we use has, at the household level, has an interest in cats. That's credit card data tracking whether you bought kitty litter or cat food, or whether you subscribe to Cat Fancy magazine. So that data, combined with how many children you have in the household, how long you've lived at the address, that is available at the household level, aggregatable and available nationwide. So you can target down to the neighborhood level exactly where you want to be, not just based on what has happened, what's happening this week in terms of household level change, and take that against the likely income growth of the people who work in specifically those industries with those commutes. And that's something that really puts all of us on the phone in a good position over the course of this decade, because there's so much migration changing cities. There's so much concentration of wealth. Certain economic vocations do much better than others. And in terms of household spending, with the advent of more children in households, that changes the type of space to be consumed. And as people migrate, which tenants you're getting. So I agree with everything on the operational side. I think that's probably the same we're finding between the US and Europe. But here in the States, there's a lot of opportunity to really target investment and in mixed use development to be able to build the environments that the people will want, not just buy where they're going.
Thanks, Hans. That was equally helpful and creepy, as you mentioned. So I appreciate that twist on it. Now we are bumping up against time. So similar to what we did in session one, I'd love to take just a few minutes just to gather everyone's main takeaway from session two. So Hans, since you're off mute, let's keep it with you.
Sure. I think two of the big opportunities over the course of the next decade, we mentioned demographics, think 36, migration, and that takes place not just at the city level, but at the household level. And then I would also mention development. There's a national housing shortage, too much retail, not enough mixed use. So there's not enough of the US that looks like the great neighborhoods in Europe. Heaven looks a lot more like London, and there's a big demand for more mixed use development.
Thanks, Hans. David, how about you?
I'm really interested to see how the markets are going to develop in these ones that aren't developed, like Europe and Asia. And looking forward to a situation where my children aren't facing rents that are completely unaffordable as they currently are in major markets where they literally rents in London have gone up for accommodation for sort of job starters by 40% in the last 12 months. So looking forward to the institutionalization of those markets and the development of more big and small operators doing really exciting things, producing really good quality stock, because it's crying out for it, I think.
Caleb?
I think it'll be fascinating to see. We all talked about the dislocation in the markets at the moment and whether we're seeing that real time and how that's coming through. And we also talked about the great stability of the investment over the long term. And I think it's just going to be interesting to see over the next 12, 24, 36 months how the market evolves and whether this is going to be an interesting buying opportunity or whether it's something where we will be glad to have stayed out in the market and have come in later. I think just seeing the current dislocation, how that all plays out, will be fascinating in the next few months and years.
And finally, Stan.
Just adding on, not repeating, I probably cannot not say, given where I come from, that importance of operations and understanding your assets and owning the data and drilling into this is more important now in the difficult period maybe than in the past. And one thing that kind of interpolates me as everybody's saying an undersupply, shortage of housing in most of the cities that we're speaking about in the US and in Europe, and which creates an investment opportunity. And I hope panels like this one will actually create an incentive or sort of a momentum to actually invest more into this and solve the housing shortage, not for this opportunity to close down to invest, but actually I think as a social challenge and as a challenge as us as individual citizens and corporate citizens, so that actually people can house themselves decently at a decent price over the next 10, 20 or 50 years in those wonderful cities that we invest in.
Well, thank you, Stan, Caleb, David, Hans, and Maria. If you're still with us, certainly appreciate all of your context, all of the information you shared with us today, all the advice you provided to the audience. Would also like to thank IREI for hosting this wonderful event and these webinars more holistically. Chase, we'll hand it over to you.
Yeah, no, obviously want to thank all of the panelists. Thank you, Nick, for all of you taking the time, and definitely want to thank the audience. A lot of questions coming in, so we obviously appreciate the engagement. Just a couple key takeaways. It is definitely interesting. I mean, with so many kind of macro level headwinds, obviously, I think one of the things that helps in having these panels is you guys being able to bring it down to an executable level, to actually know kind of things that can be done, how you're looking at it when, again, from wars to interest rates to everything going on, it's useful to have these kind of granular discussions about a specific asset class like multifamily housing in general. So I'd say everything is definitely coming back to just being cautious from things that we hear. So I think the cat data is definitely kind of burned into my mind. So want to thank you for that, Hans. I'm going to look up Cat Fancy Magazine now. So appreciate you taking the time, everyone. I want to thank our sponsors, Heimstetten, Heitman, Juniper Square, and Lionstone. We appreciate you guys underwriting this program. And then last thing, I know you guys had talked about ESG. We actually have the next IREI Live is going to be specific to ESG. We'll talk about different asset classes, and that's November 29th. So again, I know I've said it multiple times, but thank you to all of you. Thank you to the audience, and we'll see you at the next one on the 29th.